If you're a high-income veterinarian and you feel like you're getting punished for being successful, you're not imagining it. But the part I want to challenge you on is the assumption that the punishment is automatic and unavoidable. Because what I most often see is not that high income equals high tax. What I see is that high income with a passive setup equals high tax. And when I say passive, I mean your taxes are basically being decided by default. Um, sorry. Your entity structure hasn't been reevaluated in years. Your bookkeeper or CPA is focused on getting the return done correctly during tax season, not proactively shaping outcomes. Your payroll decisions are based on what feels reasonable, not what's strategically optimal. Your equipment purchases are handled reactively, and your estimated payments are either guessed or driven by fear. So when your income grows, your tax grows or your tax bill grows too. And it feels like the IRS is simply taking what it takes. Meanwhile, you're the one running the clinic, managing staff, dealing with client complaints, carrying the emotional load of medicine, and still trying to build a life outside of work. That combination is exactly why this problem persists. Because when you're busy, you don't have time to step back and redesign the system. Today, I'm going to walk you through the real reason high-income vets overpay the IRS on average by 25 to $100,000 per year. And I want you to listen for one thing. Which part of your system has been left on autopilot? Let me just make sure this is working. Looks like it is. Okay. So I want to start by defining what overpaying actually means, because I'm not saying you can get your tax bill down to nothing. High income vets are going to pay taxes. The question is whether you're paying the minimum legal tax liability that matches your reality, or whether you're paying extra simply because the plan wasn't built. Overpaying in this context looks like unnecessary self-employment tax exposure, missed or mistimed deductions, underutilized retirement strategies, poor coordination between business profit and personal tax planning, and estimated payments that aren't based on updated projections. What makes this so frustrating is that none of it shows up as a big red error on the return. Everything can still be right, and you can still be losing tens of thousands of dollars. This is why so many high-income vets feel stuck. They're looking at the return like it's the problem, when the tax return is really the scoreboard. The game is being played all year long: how you pay yourself, what you buy, when you buy, how you track it, and whether anyone is proactively modeling your options. The most expensive phrase in tax planning is, "We'll see what it looks like at the end of the year." If you're a high-income vet, waiting until year end is how you'll end up with a number you can't change. If you're new here, I'm Cassie Sykes. I'm an enrolled agent. I work with veterinarians mostly, and I spend a lot of my time inside the messy middle, not the polished highlights. I'm looking at the real numbers, what your revenue looks like in practice, what your cash flow actually does month to month, what your payroll is set to, what your debt payments are doing, and where your money is getting trapped. And I want you to know that when I talk about overpaying, I'm not talking about theoretical strategies that only work on paper. I'm talking about what consistently shows up in real veterinary businesses: high revenue, decent profit, but cash feels tight and taxes feel brutal. That combination is not an accident. It's usually a sign that the business is productive, but the financial system is under-designed. The clinic grows, but the planning doesn't. And if you've never had someone proactively connect your bookkeeping, your payroll, your retirement choices, your equipment purchases, and your estimated taxes into one strategy, you're not alone. Most vets haven't. Sorry, the tech on this is hard sometimes for me. So the first major reason that you're overpaying, it's usually the biggest dollar impact over time, is the wrong entity structure. So most vets are still operating as a sole proprietor or a single member LLC, taxed as a sole proprietor, even when your income has grown to a level where that structure becomes extremely expensive. In that setup, your profit is exposed in a way that gives you very little flexibility. The business and you are essentially the same tax engine, and when profit increases, the tax exposure increases right along with it. The reason this leads to overpayment isn't because the structure is bad. It's because it's often not appropriate once you reach a certain level of stable profit. If you're consistently generating meaningful profit and you're still in a structure that treats all of it the same way, you're likely paying more than you have to. Here's what makes it worse. Many vets assume entity structure is a one-time decision. Like you pick it when you open the doors and that's that. But the truth is that your entity structure should be reviewed as your practice grows, because a structure that made sense at 120K of profit may not make sense at 300K or 600K. Another piece of this is that vets often have complexity layered on top. Associate income, relief work, side consulting, ownership in multiple entities, real estate, equipment loans, buy-ins, buyouts. Each one of these creates planning opportunities, but only if your structure and reporting support it. If your current accountant is only filing what happened and no one is modeling what should happen going forward, entity structure becomes one of the most expensive blind spots in the entire business. The next thing I want to talk about is equipment, because veterinary practices are equipment-heavy businesses. Diagnostics, imaging, lab machines, dental, surgical equipment, computer systems, this is normal. And from a tax standpoint, that should create real leverage. But what I see most often is depreciation being used in a way that's either too reactive or too simplistic. Either the practice isn't capturing the full benefit because the books are sloppy, purchases aren't categorized correctly, or documentation is missing, or depreciation is used like a panic button at year end. The problem with using depreciation as a panic button is that it's rarely coordinated with your broader plan. Depreciation impacts more than just this year's taxes. It affects next year's taxable income, it affects projections, it can influence how you plan for payroll, retirement contributions, and even lending or future buyout planning. Strategic depreciation means you're looking ahead and deciding how to allocate deductions in a way that matches your income trajectory and your goals. It also means you're not buying equipment just for a write-off. You're buying equipment because it supports your clinical strategy, and you're taking the tax benefits intentionally because your accounting system is clean enough to support it. Also, for high-income vets, the biggest missed opportunity isn't just, do you have depreciation? It's, are you coordinating timing and modeling so you're not accidentally creating a future tax spike or missing deductions you could have planned for? That's the difference between using depreciation and using it well. The next area where the money gets big, especially for high-income vets who have stable profitability, is retirement. Most vets are contributing to something, an IRA, maybe a 401k, maybe they have a plan through the practice, but it often isn't being coordinated with the bigger picture. It's treated like I'm doing the responsible thing, not I'm using one of the most powerful tax planning tools available to me. For high-income vets, retirement planning isn't just about saving for later. It's about choosing the right structure and then funding it in a way that aligns with payroll, profitability, cash flow, and tax exposure. If you're making decisions on retirement contributions without modeling, you're almost guaranteed to leave money on the table. And here's the part most people miss. Retirement strategy is not one size fits all. What makes sense for one practice owner may not make sense for another, depending on staffing, income, goals, debt, and where they are in their growth cycle. The default approach is almost never the optimal approach for a high-income clinic owner. When retirement planning is treated as a checkbox on somebody's list, it becomes a missed opportunity. When it's treated as a coordinated strategy, it can move the needle dramatically. With estimated taxes, this is where I see a lot of cash flow pain show up. Some vets overpay estimates because they're terrified of penalties or surprises. They'd rather throw money at the IRS than risk being wrong. Other vets underpay because they're using last year's numbers or because their income is lumpy and they're guessing. Both approaches are understandable, but they can be expensive. When estimated taxes are done right, they are engineered. They are based on updated profit, updated projections, and real-time decision making. They're not a set it and forget it number you carry all year long when your income changes. If you're a high income vet and your business has seasonal swings, equipment purchases, hiring changes, owner pay adjustments, or expansions, your tax exposure changes throughout the year. If your estimates don't change with it, you're either lending money to the IRS interest free or setting yourself up for a surprise you could have avoided. That's one of the most frustrating parts. It's not just the total tax that hurts, it's the uncertainty. It's the constant feeling that you don't actually know what's coming. Good planning replaces that uncertainty with predictable numbers. This last one is one I want you to hear without judgment because it's very common. So, a compliance only accountant is not necessarily a bad accountant. They can be excellent at what they do, filing accurate returns, meeting deadlines, keeping you compliant with the IRS in the state. I do compliance only work for some clients, but compliance is not planning. When you pay for compliance only work, you are paying for reporting, after the fact reporting. You are not paying for planning, strategy, or proactive guidance. And those things are not included by default. If your accountant meets with you once a year, asks for documents, files a return, and tells you what you owe, that is compliance. That is the service being delivered. It does not mean they're withholding advice. It means advisory was never part of the engagement. And this distinction matters because compliance work is always backward looking. It's based on what already happened. By the time your return is filed, the decisions that actually change outcomes have already passed. High income veterinarians don't run into problems because returns are filed incorrectly. Um, um, they do, but not all the time. They overpay because no one is helping them make decisions during the year. Things like pay structure, retirement funding, timing of equipment purchases, how profit is handled, how income is tracked, and whether the books are clean enough to support strategic moves. Those decisions don't live inside a tax return, they live inside planning. So when there's no proactive planning in place, you don't get a customized outcome. You get the default outcome. And for high income vets, the default outcome is usually a higher tax bill than necessary. Here's how this becomes a $25,000 to $100,000 problem. And this is $25,000 to $100,000 every year. So each one of these issues creates leak points. The wrong structure creates unnecessary tax exposure. Reactive depreciation causes missed opportunities or poor timing. Checkbox retirement planning fails to reduce taxable income effectively. Guess-based estimates either trap cash with the IRS or cause surprise bills. Compliance-only support prevents proactive decisions from happening at all. When these leak points stack, you end up paying more, stressing more, and still not feeling like you're building wealth at the pace you should be, considering how hard you're working. And the reason it escalates is because income tends to rise faster than planning infrastructure. Clinics grow and the financial system stays the same. That gap becomes expensive. I want to give you a quick self-check while we're live. Actually, make sure this is still working. Yeah, it is. If you're a high-income vet, ask yourself, when was the last time someone modeled your options instead of simply filing your return? When was the last time your entity structure was reevaluated? When was the last time depreciation strategy was discussed before year end? When was the last time your estimated payments were adjusted using updated projections? If the answer is, I'm not sure, or we don't really do that, you're very likely overpaying. Not because you're doing something wrong, but because the system isn't, or your system isn't designed to minimize taxes legally. High-income vets who stop overpaying don't rely on one annual meeting, they rely on a rhythm. That rhythm includes clean bookkeeping, consistent financial review, and proactive planning checkpoints throughout the year. It's the difference between managing by memory and managing by data. When you have a rhythm, you can make decisions early enough to matter. You can predict your tax exposure instead of fearing it. You can set your estimated payments confidently. You can plan major purchases with clarity, and you can make retirement decisions that actually fit your situation. The rhythm doesn't have to be complicated, but it does have to exist. Otherwise, you're back to year-end panic and expensive surprises. If what we covered today highlighted any gaps, uncertainty, or even just a sense that things could feel more organized, that's completely normal. Most veterinarians aren't missing effort, they're missing clarity. The challenge isn't knowing more strategies, it's understanding how your income, personal finances, and cash flow actually work together in real life. If you want help applying this to your actual numbers, you can book a free profit and cash flow analysis. During that call, we'll walk through your income and cash flow, identify what's working, where money may be leaking, and map out clear, practical next steps. No pressure, no jargon, and no unnecessary digging into your practice books. You can book a time at the link on the slide, or I'll also drop it in the comments. Before you go, I want to incredible resource designed to elevate your veterinary practice's financial success. I put together a free ebook just for you. It's called 7 Financial Strategies. Inside it, you'll discover practical steps to increase profitability, improve cash flow, and make smarter financial decisions for your practice. You can grab your free copy in the comments. All right, that's it for today. If this helped, please pass it along to another vet owner who could use a clearer picture of their numbers. And if you're ready to get your numbers dialed in, go ahead and book that free profit and cash flow analysis. See you next time. Thank you so much.